Hello, economic students. It's nice to know that there's still some of you out there watching. So I thought I'd do a little video on monetary policy in 2024. And of course, as per the VCAR study design, you also need to understand some contemporary economics here, what is actually happening today and over the past 2 years. You need to know one example, only one, of an unconventional monetary policy tool over the past 2 years. And just like in budgetary policy, you need to understand the stance of monetary policy over the past 2 years. And as we did with budgetary policy, you need to be able to link that stance to the achievement of our domestic macroeconomic goals and living standards. I probably won't do an example of a question in this video, but you'd use the same setup. Okay, a couple of things have changed in monetary policy land since probably last year's videos. We have a new governor, Michelle Bullock, over here. She's doing a few new things. She is doing press conferences after she announces the target cash rate, whether that's changed or not. And she's only doing that 8 times a year, not 11. So keep that in mind. One unconventional monetary policy tool that's been used a lot over the last 2 years, and probably the easiest one to understand, is forward guidance. Now remember, forward guidance is just providing information to markets and to the public about the future course of interest rates and the future course of monetary policy. So they're not as strong as they used to be, and they're a bit more vague in their language. Because the RBA did get in a bit of hot water about providing too specific forward guidance. But these are the things that Michelle Bullock has been saying in her last, I guess, forward guidance, in her last cash rate decision. Firstly, inflation remains above target and is proving persistent. We can't get it back down to 2 to 3%. We're worried. Secondly, the outlook remains highly uncertain. They've got lots of inflationary forces and lots of deflationary forces. And what the big wigs at the RBA are trying to do is weigh those things up and work out what's likely to happen to inflation in the future. So we've got things like she's saying there's still excess demand in the economy. So aggregate supply still is not perhaps keeping up with aggregate demand, which would be inflationary. Wages growth is high, and it's not being met with productivity growth. So on the demand side, there's more spending from wages growth. On the supply side, there's more cost pressure. Both population growth and consumption are still growing. So whilst the economy is slowing down, we've still got population growth, which still means more spending. And also, if we think via the wealth channel or the asset price channel of monetary policy, housing prices have grown much stronger than they expected, and other asset prices like shares. And that's creating a bit of a wealth effect whereby people are still continuing to spend because the value of their house is higher than they expected. There's also a change in the saving ratio. Um, Overseas economic growth, it looks like China and the US are growing again. She's basically putting everything on the table and saying, hey, we have all these different things going on, and we're not really sure what's going to happen. We don't know. However, most importantly, we will respond to economic data as it comes in. Basically, if inflation remains too high, we are going to, as per our main goal, return inflation to target. That's our main priority, and we'll do whatever it takes to do that. And I think she uses the language, we are resolute in our determination, which is a very formal language, and saying, basically, we'll continue to raise interest rates if we need to, if inflation doesn't come back down towards target. So that's the forward guidance. Another type of unconventional tool is asset purchases. If you didn't do this one in class, then just sort of tune out. But the RBA are no longer purchasing assets, and actually they're allowing a lot of their assets to be repaid. And you can see that here on this little chart. It's a bit hard to see, but the RBA over sort of the COVID issues purchased lots of bonds to decrease the interest rate on those bonds. And now that they're letting those assets, or they're decreasing and they're not repurchasing bonds, you can see that the assets that they own or bonds they own is decreasing. What does that mean? Less demand for bonds leads to a decrease in demand. And if you've done this, you know that there is a inverse relationship between the price of a bond and the yield. So interest rates are going up on bonds because there's a decrease in demand. So also another unconventional tool that the RBA is using to ensure that inflation remains or comes back down towards target. So what's the stance of monetary policy? Now, this is the cash rate over the past 2 years. We've gone from basically zero here when I was lucky enough to buy a house and think everything was really good to 4.35 today. That's been quite a steep change in the cash rate. But just remember that in terms of the stance, our sort of neutral rate of 3% here, wherever it is, around 3, determines whether the stance is contractionary or expansionary. So all the way up until the end of 2023, the stance was still expansionary, and it's only when it rises above 3% that it is contractionary up here. So the stance is contractionary at the moment, uh, but the RBA is concerned that it's not contractionary enough. It's not bringing inflation back towards target. So if we put the cash rate and inflation together, you can see that the lag of monetary policy, one of the weaknesses of monetary policy, here when they started increasing the cash rate, inflation continued to rise to 8%. And it's also because, remember, up until here, this is still an expansionary stance. This is still growing the economy. And it's sort of only when it gets above 3% here ish that inflation starts to come down. And that's because that's when it becomes contractionary, according to the neutral rate. That is the current state of monetary policy. You could just apply the same framework that we looked at in the last video for budgetary policy. You may be asked to explain how the monetary policy stance is helping to achieve one of our 3 macroeconomic goals, and you would do exactly the same thing. You would just use the monetary policy stance. All right, bye for now.